SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to the SUERF-BAFFI Bocconi e-lecture on key takeaways from the ECB's May 2025 Financial Stability Review. Geopolitical and policy uncertainty have surged further since the ECB's November 2024 Financial Stability Review. Uncertainty stems from several policy areas, including trade, regulatory, and fiscal policies. Unpredictability of a broad range of US policies triggered significant volatility in financial markets. Protectionist responses might escalate into a fully-fledged global trade war with adverse repercussions on growth, inflation, asset prices, and so on. At the same time, there are indications of a redirection of financial flows from the US towards the euro area with exchange rate implications. So what are the risks of financial market adjustments becoming disorderly? What, if the fallout of the trade conflict triggers a deterioration of household and firm creditworthiness? How about risks from public debt sustainability in this challenging environment? On 21st May, the ECB released its latest FSR. We're privileged to have the ECB's leading mind behind the FSR with us today to present key findings. A heartfelt welcome to John Fell, Deputy Director General, Macroprudential Policy and Financial Stability of the ECB, and also SUERF Fellow. Welcome, John. Thanks for being with us today. For the 11th time, the 11th vintage of FSR presentation. John's presentation will be followed by comments and further inputs by two top financial stability experts. A warm welcome to Kirstin Hubrich, Deputy Director General for Financial Stability at the Deutsche Bundesbank, formerly OeNB, Fed, and ECB. Warm welcome, Kirstin. And to Stefan Kerbl, Principal Economist, Financial Stability and Macroprudential Supervision Division at the Österreichische Nationalbank and lecturer on international economics at the University of Vienna. Without further ado, over to you, John.
So, let me repeat it. So thanks to you, Ernest, and to the SUERF board for inviting us once again to share the findings of the FSR with the SUERF community. We greatly value these opportunities, and not only for the sharing, but also for the valuable feedback of the discussants and all the colleagues who join these webinars, be that on this issue or, as we've had in the past, ideas for the future. So I'm very much looking forward to hearing what Kirstin and Stefan have to say. So, Anna, if we could go to the next slide and diving straight in, having steered the ECB's FSR for 20 odd years, I can say this time has been rather different. In the 4 months since a new administration took over the reins of US government, it has unveiled a series of major economic and financial initiatives. Tariffs on trading partners, a budget resolution featuring an estimated $4.5 trillion in tax cuts, and proposals for mass deportation of undocumented immigrants. Now, while these initiatives were largely flagged during the presidential campaign and so should not have been a total surprise, the sheer speed and scope of implementation did catch markets off guard, as did several geopolitical developments. Global financial imbalances, and by this I mean both trade imbalances and their financing, have been latent for a long time, but they have returned to the fore. We witnessed frequent policy shifts since January aimed at addressing them, as well as reversals of those policy shifts. And this has resulted in pronounced economic policy uncertainty, both in the US and in Europe, and it also triggered market volatility worldwide. Now, on this slide, we can see that US economic policy uncertainty reached at least 4-decade highs in April. And that's only because the data only goes back that far on a comparable basis. It probably goes even further back. In the middle, the red dots mark the latest readings. And here, trade policy stands out. We even had to use a different scale to show together with readings for the other policy domains. Most striking is the fact that uncertainty rose across almost every domain that one can think of. So including, as we have here, monetary, fiscal, regulatory, and even national security, and to levels not seen since at least the mid-1980s. There have also been calls for greater self-reliance in the defense domain through higher spending. The most prominent step taken being the landmark constitutional amendment in Germany in March to relax the so-called debt brake. Now, while it can't be excluded that higher defense spending could serve to boost growth at a time of economic weakness, this pressure also comes at a time of concern about sovereign debt sustainability. So we go to the next slide, and against this background, our overall assessment is that the core financial stability vulnerabilities have not changed much, although trade reliance, more commonly thought of as a strength, has, in a world of trade conflict, taken on characteristics of a vulnerability. That said, the greatest change has been the scope of likely triggers. Going through the three, if I go through the three main vulnerabilities, first, we continue to see stretched evaluations across several asset classes, especially in corporate bond and equity markets. And at the same time, worrying concentrations have built up among a small number of US big tech stocks, amplified by a rise of passive index investing. We covered this in the last FSR. And then we have a small number of non-bank market makers behind the ETFs that are driving those structural changes. Now, our view is that these vulnerabilities make asset markets more prone to disorderly adjustment, especially as liquidity and leverage fragilities of non-bank financial institutions could, through fire sales, amplify asset price declines. Now, the second vulnerability is rising trade tensions, which we think could affect Euro area corporates and households, and they could affect these non-financial sectors both directly and indirectly. So direct channels include exposures of financial institutions to tariff-sensitive sectors, and then the indirect channels center around confidence effects, which inter alia could lead to more cautious investment decision by firms, and greater risk aversion in bank and non-bank lending behavior. And then third, weaker growth usually has adverse consequences for financial stability. And the reason for this is because it weakens debt service capacity. Now, for some sovereigns already facing a range of structural challenges, and the list is long, be these digitalization, decarbonization, aging, etc., pressure to raise defense spending coming on top of all that could, unless it boosts growth, compound already strained fiscal positions. And then if we take a more holistic view, this slide shows an ordering of these sources of risk and vulnerabilities, and you can see arrows going down between them as well. This ordering is based on an assessment of probability of materialization and the likely impact, and we're usually talking about a horizon of 18 months to 2 years should a vulnerability unravel. Still, we know they cannot be independent, since any of them could be unraveled individually by common triggers. And that means there is a possibility of all of them materializing simultaneously in a worst case scenario, possibly amplifying each other in the process. Now, going to the next slide and turning to the first of these vulnerabilities, financial market vulnerabilities, perhaps the most eventful development since the last episode was the market reaction to the announcement of so-called reciprocal tariffs on the 2nd of April. We saw stock markets plunging worldwide, and investors fled to traditional safe havens like gold. The chart on the left provides a sense for the net impact across a range of asset classes. Probably I should have done those on a log scale, because you could see when we separate the impacts of the reciprocal tariff announcement and then the 90-day pause on these measures. So the first group, the first set of reactions is in red, and the second in green. If we take account of both the impact of the announcement and then the reversal brought in to say we're more or less back to where they started by mid-May, which was the cutoff date for our analysis. Now, if we take a somewhat longer perspective compared to the situation when we published the last FSR that was in November, while still indicating overvaluation based on a broad range of indicators, you can see there on the middle, US equity valuations are a little less stretched than before, and Euro area valuations a little more stretched. Now, at the same time, on the far right, Euro area corporate bonds are somewhat wider. Still, they have been relatively insensitive to heightened economic policy uncertainties. You can see there on the right, possibly because of the challenges that market participants face in pricing assets when they are unsure about the end game of the trade tensions. Spreads have also decoupled from other known drivers, though, and for that reason, we think both equity and corporate bond valuations remain vulnerable to adverse tariff or economic news. Now we go to the next slide. Although markets generally function smoothly in the turbulent week after the announcement of reciprocal tariffs, some financial stability concerns were raised by market dynamics. Unusually, US Treasuries, which typically benefit from market turmoil, experienced selling pressure, causing yields to spike as the dollar weakened. And then, as you can see there on the right, market volatility surged across a broad range of asset classes. It's a bit harder to see, but we also saw some correlations breaking down during that period as well. Now, outsized asset price movements often trigger margin calls, raising counterparty risk for the lenders, and then correlation breakdowns. But we've seen these kinds of breakdowns behind some infamous cases of financial instability in the past, the collapse of long-term capital management in 1998 being one notorious example. We didn't get anywhere near that far, but these kinds of market dynamics do raise some financial stability concerns. So digging in a little bit deeper into that on the next slide, and to give a sense of how unusual the rise of treasury yields was, the left chart shows impacts, the impacts being marked by the yellow dots here during what might be called the tariff tantrum. And we're looking at the impacts on the dollar, 10-year US Treasuries, and bonds in comparison with typical market impacts during periods of equity market stress. Those typical impacts are marked by the blue dashes inside those shaded interquartile ranges. So as you can see, going across this chart, the dollar moved in the wrong direction, but this wasn't significant in a statistical sense. So it's a wrong sign, but it's within that interquartile range. Then if I go to the far right of that left-hand side chart, 10-year bonds did exactly as described on the tin, behaving like a safe haven asset should. But yields on treasuries, often thought of as a safe haven asset, didn't decline as they usually do. You can see that the grey shaded area is mostly mostly below the zero line. And with that dot having the wrong sign and being far outside the range, it comes close to being a black swan event. Now, various narratives explaining these market dynamics have circulated, including shifts in safe haven perceptions and forced unwinding of leverage positions. For instance, the so-called basis trade, a highly levered arbitrage trade that we've covered before in the episode. There were also reports of market liquidity strains arising from balance sheet capacity constraints, as well as de-risking and technical factors such as mismatches in derivatives markets. So quite a number of competing narratives and hypotheses. At this stage, I think it seems fair to say that nobody really knows for sure. But what we do know is that some hedge funds and some market makers endured sizable losses. There were, though, no reports of failures, thankfully. But a few more days of that, and I think it would have constituted a stress test for a fairly extreme event. Now, if we go to the next slide, and a pattern that we have often seen at times of market stress is so-called pro-cyclical outflows from investment funds. So to describe that, to describe what I mean in plain man's English, this is situations where individual investors in those funds panic and demand their money back when they see prices are falling. Now, the pattern is visible there on the far right of the chart. On the right, you can see after the 01/25 period, you can see a period where both prices and outflows from funds are going down at the same time. Now, this is a recurring feature in the data. And on the left, we have investing styles which suffered the most from this kind of market dynamic highlighted. Now, for financial stability, the concern is that funds they get those kinds of panicked requests and they have low cash or liquid asset holdings, and they may not have sufficient resources to pay their investors back, and so they may be forced to sell assets to redeem those panicked clients, or indeed maybe to meet margin calls if there are some leverage positions. And that can push prices down even further, and you get into a kind of an adverse, self-reinforcing adverse dynamic loop. And we find that this vulnerability is most acute for funds investing in corporate bonds. Now we go to the next slide, and the second vulnerability. Several economic sectors exhibit vulnerabilities to tariffs. Now these two plots on this diagram are showing end year 2024 data, and it shows that firms in the machinery and transport, manufactured goods and chemicals industries accounted for 84% of all exports and 72% of all imports for the euro area. Now, abstracting from intra-EU trade, the US is the most important export sector, the most important export market for euro area firms in these industries. China, on the other hand, is the most important trading partner as far as imported goods are concerned. So what that essentially means is that escalating trade tensions with the United States on a multilateral basis could have dual repercussions for euro area firms' financial performances. So first, their products will face tariffs on goods exported to the US, and that's going to have adverse consequences for profit margins and our sales volumes, depending really on whether firms absorb the tariffs or not. But second, domestically, they could also be faced with stiffer competition from Chinese and other countries' firms facing US tariffs as well. And so we got a kind of a rerouting of goods by third countries into the euro area, which could threaten domestic sales, our margins, or both. So some firms in some sectors can be squeezed both sides by this. Autos, for example, is commonly referenced. Now we go to the next slide, zooming in a bit further on vulnerable sectors. The chart on the left here attempts to capture 4 dimensions in 2-dimensional space. So I go through it slowly. So the 4 dimensions here are reliance on foreign markets for revenues, then reliance on foreign inputs, and they're measured on the X and the Y axis. And then we have high or low growth sectors depicted by different colors, and then relative size of the sector depicted by the bubble size. So if you look up to the top right-hand corner where the vulnerabilities are the greatest, the manufacturing sector stands out. And auto manufacturers, as I said, which feature more and more in the financial press, would be included in this bubble. Then on the right, up to now, we have viewed labor hoarding by euro area firms as a source of financial stability, fueling a kind of a virtuous cycle with corporate profitability. For instance, I mean, you remember in the early days of these webinars during the pandemic, despite firms enduring a collapse in revenues, they held on to their employees. Now, you can see that this has actually continued after the pandemic. Now, if despite all the shocks that we've had in the meantime. Now, if these dynamics were to reverse, triggered, say, by rising layoffs, that could strain household balance sheets. So households would have less income coming in, savings would be running down, etc., and that would affect the credit quality of consumer loans and mortgages, and then ultimately, of course, feeding back to firms as well, to the extent that aggregate demand would be adversely affected. Now, we go to the next slide. This time we have a special feature on the financial stability impacts of trade tensions. And we look at a range of variables, including bank provisioning, profitability, and lending to the real economy. So the chart here on the left is just showing a selection of some of the analysis that is done on that special feature. It summarizes impacts on the cost of risk, and then making it conditional on exposures to firms with high or low foreign input and market reliance, so the variables that I had on the previous slide. And as you can see there, this separation that we made in the previous slide, both forms of reliance matter. The impacts are clearly a lot higher for firms with high reliance of either type. Now the charts, and of course you can get some firms that have both types. Lower house again. Now these charts illustrate the impacts of one standard deviation shocks. And if you look there, I mean, if you squeeze your eyes to see the figures, they're not really huge. And we think that the prevailing buffers would be more than adequate to absorb those shocks. Still, those aren't stress tests. They're one standard deviations. They're kind of normal changes, normal shocks. Larger shocks, multi-sigma events, would have larger impacts than these that are shown here. So there are really no grounds for complacency. Now, quickly on last vulnerability, and this is the whole question of whether higher defense spending will strain public finances or not. The chart on the right shows that some lower defense spending countries have large debt servicing commitments over the next few years, and of course that's coming on top of all these structural challenges that I mentioned in the intro. And the question really is whether raising defense expenditures, whether that leads to strains, will depend on whether it supports growth or not. Now, we didn't do own analysis on this, but in the FSR, but we do reference some academic literature. In particular, we reference an extensive meta-study on the topic, and also a paper which explains why meta-studies may not come up with conclusive results, because the answer really depends. And it depends, I think, the two factors that seem to be very important in determining the size of the so-called defense spending multiplier, or whether or not the countries concerned are advanced economies, and whether or not whether they are going through a recession or not. So it finds that advanced economies have double the defense multiplier of emerging economies, and it also finds that you can double that multiplier again when you have weak economic growth. So we think that the possibility of a boost to growth on the basis of the literature that is out there, it can't be excluded, at least scientifically, especially at a time when growth is subdued. Now, before concluding, let me just summarize the messages on policy on the next slide. Our headline message is that macroprudential buffers, which have been built up, should be preserved. The message is now is not the time to be releasing them. We think it is better to keep powder dry, so that if or when the time comes, they can be released, avoiding amplification, the kind of amplification that we've had in the past. For non-banks, we continue to advocate a prudential policy framework which takes a macroprudential perspective. So avoiding risks of the kind of amplification that I described earlier, when low liquidity levels in funds meet heightened market volatility. So concluding with the next slide, our headline message is that a rapidly shifting geopolitical environment could test euro area financial stability. Now, if that seems too reminiscent of Greenspan speak, and Ernest, you would know what I'm talking about when I talk about Greenspan speak, let me take a moment to explain. And for those on the line who might be too young to have familiarity with the concept, Alan Greenspan, former chair of the Fed, told a US Senate committee in 1987 that if I seem unduly clear to you, you must have misunderstood what I said. So deciphering our message, while focus on the vulnerabilities guides our assessment, what we mean here is that triggers will determine the nature and the speed of adjustment. And until a lasting solution of this trade conflict can be found, we think the likelihood of tail events is very high. Still, on the positive side, our assessment is that the core of the euro area financial system is resilient. Bank profitability is no longer the concern that it once was, with shock absorbing capacity underpinned by healthy capital and liquidity buffers. And then outside the financial system, corporate profitability has been a pillar of resilience, allowing firms to retain labor, as I explained. Still, we don't think there's any room for complacency. We think several vulnerabilities could be unearthed in this highly uncertain and volatile environment. So I'll stop there. Thank you.
Thank you very much, John, for this excellent overview of key findings of the FSR. Now, I have my own copy here. I printed it out in advance and had a look. There is definitely much more in there, but you gave an excellent overview. It is now my pleasure to hand over to Kirstin Hubrich. Kirstin, the floor is yours for your comments.
Thank you very much for the invitation. It's a pleasure to be here and to discuss the ECB Financial Stability Report. Thank you, John, for this very nice overview, and to you and the team for putting together the ECB Financial Stability Review in these rather challenging times in face of large, rather high uncertainty. Now, we agree with the overall message of the report, so let me share some observations and thoughts and present some of our own analysis to complement what John just presented. Now, the macro-financial environment remains challenging in light of this high geopolitical tensions and heightened uncertainty, and that is also discussed in the ECB Financial Stability Report. And I think one thing that is really clear from this analysis is that the spectrum of possible adverse scenarios has significantly expanded. Now, let me illustrate for you with some internal analysis the effects that we see on of EU tariffs and reciprocal EU measures on financial indicators of EU non-financial corporations across different scenarios. So basically what you see here are three different scenarios. One is a scenario where we have the Trump 10%, the blue bars present the US tariffs on EU imports of 10%. The green bar is then 10% plus EU retaliation of 10%. And the red bars present a Trump scenario of 25% tariffs and 25% EU retaliation. So these all these scenarios are actually complemented by assumptions on the US that the US imposes tax cuts and that there is a labor supply shock by expulsion of migrants. And what you can see here is basically that these lead to a deterioration of financial indicators of EU non-financial corporations across these different scenarios. And of course, in the more adverse scenario, you find that the debt ratio and the spreads are increasing more, and equity valuations are declining more. So to give you a historical perspective, the harsh scenario here, so the 25-25 scenario, leads to effects on NFC financial indicators that are roughly comparable to those observed during the corona pandemic. Now, I should also mention that the results are robust to additionally imposing an initial drop in US equities and a depreciation of the US dollar, as observed after the April 2nd, which is kind of was what John just described before, an unusual reaction that took place here. So we see these effects nevertheless. And so overall, we get a substantial negative effect on the financial situation of EU non-financial corporations. Now, this comes on top of credit risk rising in general anyway. So in addition to these rising credit risks that we observed that are, like for instance in Germany, we are seeing since the increase in interest rate in 2022. Now, to illustrate a bit more that the situation of non-financial corporations in Germany, here you see corporate insolvencies on the left panel. Corporate insolvencies have significantly increased, although from a low level. This is due to the German economic development remaining weak. And on the right-hand side, you see then the development, you see then insolvency claims, and they are at an average, above average level historically. And you see here that particularly here for the service sector, for the real estate and housing sector, and also for the trade sector. And so these three sectors together account for nearly 70% of the related bank loans. Now, regarding banks, even though overall banks in Germany are well capitalized and rather resilient in our assessment, since 2022, you see on the left-hand side of this chart, write-downs have increased substantially. And on the right-hand side, you see some scenario analysis that we have done, and that illustrates that write-downs may increase further in 2025, in particular in a weak economic environment. Write-down rates could rise sharply. And now turning to asset valuations that are currently high. So we agree also with the ECB Financial Stability Review that there is large potential for asset price corrections. It was surprising that prices of risky assets, in particular of risky assets, have recently fully recovered their previous losses. And due to the announced pause on reciprocal tariffs and the temporary agreement between US and China, and even after Friday's announcements of the tariffs and then taking these back or pausing that until the 9th of July. So even though financial markets have recovered so far, volatility and valuations remain high. And so the potential for asset price corrections also in our view is very high, perhaps even higher now than before April 2nd due to the high uncertainty that we see, and that could test the resilience of intermediaries. So, and valuation levels of risky assets are particularly high and appear not to reflect the prevailing high macroeconomic risks. Now, turning to the residential real estate and the commercial real estate markets, here we face in Germany very different challenges and outlooks. You see on the left-hand side of this chart that residential real estate prices are stabilizing. In our assessment, overvaluation have been largely eliminated, and an orderly reduction of residential real estate vulnerabilities for Germany, we see the likelihood of that is rather pronounced. Now, on the right-hand side, prices for commercial real estate, you see them, they are still stagnating with a slight upward trend there. We see downward risks for the German commercial real estate prices. First of all, because the low transaction volumes, many investors here go for a wait-and-see strategy, and the CRE downturn could be reignited if net outflows from real estate investment funds accelerate, triggering fire sales. So we see that the pace of CRE risk materialization still is mainly determined by the US CRE exposures of German banks. And overall, our assessment is that that there is a marked increase in US CRE related tail risk scenarios and potential of further increases, for instance, in US Treasury yields weighing on interest rate sensitive CRE markets. Now, the financial stability report of the ECB mentioned the asset price adjustment in asset markets becoming disorderly as a risk, and particularly if liquidity and leverage fragilities in parts of non-bank financial intermediation sector amplify asset price swings. And so I just wanted to add some illustration to that for the German market. Here, what the German investment fund sector has so far coped well with the sharp rise in interest rates and also with the uncertainty, but we see liquidity risks. There is a risk of high net outflows from open-ended real estate funds, and you see that retail real estate fund is the blue line down here, and the specialized funds is in the red line. And so these net outflows can exacerbate price declines in the commercial real estate market and potentially forcing funds to sell properties in an illiquid transaction market. However, liquidity risks in Germany are limited by notice and minimum holding periods. For real estate funds, that's not the case in all European countries. So there are recommendations to actually improve the macroprudential stance here. So to close, the financial system so far has maintained a notable degree of stability despite a challenging macrofinancial environment. Clearly, possible adverse scenarios have significantly expanded given geopolitical risks, weak economic dynamics, in particular in Germany, but also in some other European countries, and structural change. And to close, let me just mention that the German package of macroprudential measures currently, in our view, remains appropriate. Thank you. So thanks, John, for the presentation of the financial stability and the insights that you presented from the ECB financial stability review. And I give over back to Ernest.
Thank you very much, Kirstin, for your comments, which add importantly to our understanding, particularly and among other things, on CRE and credit exposure to trade-exposed firms. Now, let me hand over to Stefan Kerbl for your take on these questions.
Thank you, Ernest, for the invitation. And yes, I think the ECB's FSR is doing again a great job in summarizing the current stance of financial stability in the euro area and beyond. Sean, thank you and your team for this comprehensive view. It really looks into at all corners of the financial sector, NBFIs and banks alike, and NFCs. We've seen many graphs already, and the ECB's FSR is actually based on a huge data source, and the graphs are just a summary of this very important database. Let me also point out that the ECB is doing a good service by publishing much of the data that underlies those graphs. I think this is a great service to the public and maybe underappreciated so far. With the ECB now making the most of the data, I think my contribution here will be more to connect the dots and also venture a bit more into the tail risk that lies ahead. And this is also why I think that the usual disclaimer is particularly relevant, maybe, about what I'm gonna say today. I think the best way to summarize the FSR is this painting by the great French painter Claude-Joseph Vernet. Why do I think so? It shows very sturdy buildings, steadfast buildings, and I think this is what the ECB also describes in its report, where I see bank capital levels at historically high levels. We see bank profitability still strong. We also see the pension sector with good numbers, and the household sector with good numbers. And it's not just that it looks really good. It also has, I think, proven in the past years to be very resilient. We should not forget we've seen in the last years a very steep rise in interest rates. We have seen inflation and the pandemic. We have seen troubles in the US market and the Swiss market. Before that, we had Brexit and the sovereign debt crisis. So I think through all those years, the financial sector has actually shown that it's quite resilient to shocks. But, well, there's always a but, right? And you see already there the clouds. There is a storm brewing. It's a lot about what this storm is and how can it affect Europe and the euro area financial stability. Now, what I did also try to summarize is a different picture, which is I did a small text mining exercise where I downloaded all the FSRs going back to 2005, and I did a word count of many of those important words that show up. And I think now we have certainly here we see peak uncertainty, as John mentioned. We also see like the word geopolitical was like perhaps invented only in the recent issues. We see less concern with NPL still, and non-banks have gained quite importance in the FSR. We see crisis is good news, more muted. Debt sustainability remains a big issue in the report, which I think is important, and I'll talk more about this. And of course trade, right? You see really the trade issue is very pronounced there, and I think this is somehow a summary of the report, although I made more words than that. So what are the main words of the ECB's FSR? It's NBFIs, especially open-end investment funds, as we've talked about, and here also the liquidity position and the US dollar exposure, or also exposure to euro area corporates that are again then perhaps exposed to trade tensions. We have the NFC sector, as John mentioned, especially manufacturing, with quite a lot of hits they have to take. We have still elevated interest rates there. We have stagnant growth and stifling regulation. But manufacturing is also hit by high energy prices and then perhaps tariffs on top with a high import and export reliance. So these are worrying developments, and we see this also, as John and Kirstin pointed out, in worsening credit quality there. But also, of course, we have this geopolitical side of things and the sovereign risk, and I'll try to connect those points in what's ahead. I'll start with sovereign risk. I think again, I think it's important that the ECB looks into this as well. We know that, like on paper, the ECB is independent, but public sector issues are always more sensitive. So it's a good thing that the ECB does not have a blind eye on these issues, but really talks about them. And we see in the euro area, especially, the concern that we have low growth and low growth outlook, and we have a high tax burden in general, right? And the deficit is around 3% in the euro area. Whereas in the United States, we see even lower fiscal discipline, with that about 6% of GDP. And we see in combination there this chronic twin deficit, right, where we have a trade deficit accompanying this fiscal deficit, and this is as I will talk more about this, perhaps a problem. Also, the United States is certainly more dynamic and has higher growth outlook, but this growth seems to be particularly at risk at the moment. And we see these high deficits despite a situation where we have peacetime and the absence of pandemics and record lower unemployment rates, both in the euro area and in the United States. So almost record low unemployment for the United States. So these are concerning signs. I'll talk more about the United States now, which I think it's worth highlighting. Here's what we know is this trade deficit. The current administration seems to be quite concerned about. We see this trade deficit both in terms of goods and in terms of goods and services, and we see it's large, it's negative, and it's rather worsening over time. And this is what really seems to be a major concern of the current administration. Now, why is it a concern? There are many reasons for it, but one is, of course, that a trade deficit means that you create liabilities towards foreigners. And this is on the left-hand side. You see in US trillions the US foreign wealth positions, which is essentially the cumulative trade deficit over the years, right? So you accumulate liabilities toward foreigners over time, and they have grown considerably large, and this is $1 trillion, and are expected to increase further. On the right-hand side, you see the US net primary income. What is this? Well, the current account, the balance of payment, does not only have the trade deficit, import minus export, but is also on top of this the factor income from capital. So these are money from foreign investments coming in minus money from foreign investors going out. And you see, quite astonishingly, actually, that the United States has here a surplus despite their large negative wealth position. But in recent times, this has turned, right? So the volume of foreign wealth in the United States now brings this net primary income into negative territory as well. And this adds quarter on quarter, year after year, if it's negative, would add to the trade deficit and would add to the foreign wealth position. Now, what does this mean, or what kind of risk does this provoke? What I call here the US debt renegotiation is not something that I invented. This is, of course, coming out from the Mar-a-Lago Accord that you probably know or should know, I think, which is also called a User's Guide to Restructuring the Global Trading System by Stephen Miran, the chair of the Council of Economic Advisors. So it's clearly something that is not official United States position, but something that has certainly influence in Trump. And I think when you read through it, it's really quite impressive how open there it is to say we need a new system also with US debt. Right? And what I just said is a little bit the prelude to these conclusions. He suggests a multilateral approach or a unilateral approach from the United States, and a multilateral would be to exchange the current treasuries held by foreigners, especially by allies, into very long-dated century bonds that have zero coupons. And if the this doesn't work, and he connects also this negotiations with the tariffs as a second stage actually of tariffs, then one could move on to unilateral solutions here and impose a user fee on foreign official holders of treasury securities, for instance, withholding a portion of interest payments to those holdings, so especially to adversaries like China is explicitly noted there. And I think this is quite strong language there actually. So if you read through it, it's really surprising how open those thoughts are. It's attractive. So why might it happen? Of course, even though it's just perhaps the opinion of one influential person, well, it would not just, if done in extreme ways, it would not just cure the current trade deficit, it would also cure past trade deficits, right? And then secondly, you have this very large, John pointed as well to it, these very large trade deficits here on the, fiscal deficits of the United States, ranging -5 to -6%, and the recent tax cuts are not in there. It's not in there that the United States might see a recession these years. So all those information is not part of this forecast. And you see in the blue, the very large portion interest rate payments make in the fiscal deficit, right? And if those interest rate payments go to some extent or to a large extent to foreign holders, it's perhaps there's a political pressure to renegotiate those debts. So I think this is a situation that is certainly tail risk, but should not be completely off the table. I think also that one typically views yields as a market, as establishing a market equilibrium, right? If the yields rise in treasuries, it will attract more bonds. It will attract more investors to hold bonds, but it will also be an incentive for more fiscal discipline. But what it also does is, if the yields rise beyond a certain level, they also incentivize a renegotiation if especially foreigners bear the brunt. And last but not least, there's this word magic. What is word magic? In medieval times, people believed that just speaking the name of the devil would attract the devil. They were afraid of speaking certain things because they thought that speaking it would attract it. Now, I think that this is a problem, especially in financial markets, where these things can create a life of their own, can create positive feedback loops, and this is why we need to be careful here. I think still it's extreme tail risk, and we are lucky that it's very unlikely. The first problem is, of course, that you would need a very clean separation between what Trump called allies and domestic holders and foreign holders, and then probably in a categorized way according to their allied status. This is very difficult, if not impossible, right? Because China, for example, might have holdings of these treasuries. There's no upper limit on the number of intermediaries that might hold these intermediary bonds, or might hold intermediary steps of those bonds. And secondly, trust cannot be switched on and off as tariffs can. I think this is something we can hope that the US administration knows as well. So once trust is off, it's very difficult to switch it on again. And I think also that since Liberation Day, rationality has gained some influence, and markets too certainly have some influence. So this is why it remains an unlikely scenario. Let me close my comments also again with the painting. What I did not tell you before is that the painting was finished in the year 1776, which is also the year of the American Declaration of Independence, and also the publication day of Adam Smith's Wealth of Nations. And this is interesting because Adam Smith just really pointed out that trade is such an core part of the division of labor, and the division of labor again is such an important part of prosperity, and prosperity certainly is a big part of financial stability. And so if we see the clouds rising and striking, perhaps maybe the ship and the trade ship is most exposed, but let us hope that we can weather the storm like we did in the past events. Thank you.
Thank you very much, Stefan. Also, thank you for introducing us to this beautiful piece of art and the relevance that it has still today. Very beautiful image. Now, John, would you wish to comment immediately to the comments of the discussants?
Well, look, I mean, I'd like to thank both Kirstin and Stefan for those fantastic discussions. And I think both were complementary to my presentation in different dimensions. Kirstin really got into the details and, you know, showing how these developments are impacting in Germany, and I think it's a kind of, you know, a helpful case study that, you know, what we're saying at a high level for the euro area is really having yeah, impacts at the country level. Stefan, I mean, I really liked your discussion. The painting was great. I think you're complimenting, of course, is both putting what's happening from a financial stability perspective into the broader context of shifts in geopolitics, and also, yeah, I mean, that helpful thing you said at the end on history. I really liked your, you know, the work that you did on looking at the language of our FSR over time. And one thing I wasn't sure if I saw it in your charts was, because I tried to hint at it at the beginning of my presentation, the term global imbalances or global macro imbalances or global financial imbalances. And the reason I ask is because we have highlighted this terminology now in the forward of the Vice President to the FSR. We used to, I mean, so you went back pre-GFC, you said to 2005. I mean, in each and every issue of the Financial Stability Review of the ECB, up until the global financial crisis, we were always warning about disorderly unwinding of global imbalances. And, you know, we saw that as, yeah, the manifestation of, yeah, global macro imbalances, you know, the rising the fiscal position in the US, you know, trade imbalances, and so on, and also the way in which those imbalances were being financed. And, you know, we saw potential market-based potential for, yeah, currency volatility, treasury, bond market volatility, and so on. So I think it's but it's nice the way that you put it in context. I think that we never really had envisaged that it would be, you know, policy, deliberate policy intention to try and rebalance. And so I think you explain it nicely. And of course, we are aware of the so-called Mar-a-Lago Accord. We don't refer to it in the episode because it isn't adopted, as far as we know, as the official position of the US administration. But of course, you know, being the risk managers that we are, I mean, we look for all potential clues of sources of instability. And so I think it's yeah, thank you for that. But both of you, I mean, I think it was yeah, really helpful.
Thank you, John. Meanwhile, we have two questions in the chat.
I mean, I think the first one is a good one. I mean, asking whether or not geopolitical risk can affect climate-related risk. Well, I think the straightforward answer to that, by the way, we haven't looked at that in great detail in this particular issue, but we do from issue to issue look at climate risk is always there as one of those longer term structural risks. I mean, I think you can identify, you're asking for specific channels, but I mean, I think policy and regulatory uncertainty, for instance, and especially if geopolitical risk can lead to reprioritization of different policy priorities. maybe climate kind of, maybe not as high on the priority list when, there are say defense spending type of priorities. Energy security, of course, is an issue, and also, I mean, I think we saw this whole issue of fossil fuel dynamics, and what happened at the outbreak of the war in Ukraine, where suddenly the demand for fossil fuel type energy sources rise, supply chain disruptions, and I think you can think of a lot of different challenges. But I think ultimately, geopolitical risk, I think, can have impacts on incentives. It can delay the action on policy change, and it can of course disrupt economic and financial activity. I think also, though, important as well, I mean, I think you can get feedback in the other direction as well, that climate change can affect geopolitical. There is a kind of a feedback loop there. I'm thinking of, for example, the whole discussion on the melting of the ice caps, how that opens up new routes, shipping routes, submarine routes, and changes a bit the geopolitical calculus. And we know as well that climate change can also affect, maybe it becomes impossible to grow crops on land. That can cause waves of migration and so on as well. So I mean, I think there are a lot of feedbacks at that level that we should be concerned about and monitoring. On the question on the impact on defense spending, I mean, I can really only answer this at a high level because I don't think we have all of the details yet, so I can't say specifically what impact is it going. The way that we address it in the FSO is we say under what circumstances could it or could it not have a positive impact on growth. And I mean, the most important things are, first of all, what type of spending are we talking about when we're talking about defense spending? So I mean, if you look at, for example, I had a podcast that was just released at the end of last week where I talked about a YouTuber who went through line by line every item of the US defense budget and shows that a huge amount of expenditure on things like obvious things like soldier salaries, healthcare, education of the children of soldiers and so on, that are kind of like crowding out those people. If we didn't have a priority on defense, they would be doing something else. So that's not necessarily adding to GDP. What's adding is perhaps investment in innovations and so on. But again, the source of where that money goes matters. Whether it is directed towards importing new technologies or developing them at home. So there are lots of different ways in which uncertainties could arise and why we can't be sure about what the impact would be. I mean, I think overall, I mean, we're not the question. I don't want to get into detail about ECB monetary policy and so on, but I think that the way that markets behaved in Europe through all of this turbulence, especially in the US Treasury market, as I said, the German bond market continued to be the promised, it did what it said on the tin, the safe haven, and risk averse investors are still attracted to Europe at times of stress.
Thank you, John. Stefan, Kirstin, do you want to comment on these two questions?
I mean, on the latter question regarding the impact or potential impact of defense spending, I mean, I can confirm that our view is also what John was just pointing out, that it depends on the type of defense spending. This on what of defense spending is used for, and innovation is certainly. I mean, we have seen innovations, in the past that were quite substantial that came out of the defense industry. But so it depends certainly on that. More generally, I mean, of course, we kind of have an important eye, let's say, on sustainable public finances as a precondition of financial stability, and doubts about that sustainability can lead to market turbulence and sovereign debt crisis. We see that significant holdings of domestic government bonds on bank balance sheets can reinforce problems in the financial sector and public finances, and risks from sovereign bank nexus in the euro area remain elevated. So that's our current assessment. Doubts about sovereign solvency affect banks' creditworthiness, and bank distress triggers state support measures, raising questions about sustainability of public finances. And so this feedback loop poses significant risks in our view to financial stability and macroeconomic developments. And so, I mean, for Germany, of course, the fiscal debt brake relaxation is potentially helping offset the negative impact of higher tariffs, potentially, if that comes along. So we see there is a positive to that, and from that perspective, apart from general considerations, and on the other hand, market concerns regarding fiscal sustainability of the US, for instance, have increased recently, and so there is a question of safe haven movements. What we see at the moment is that there are not much changes in the value and yield of US treasuries, although we see some reduction in exposures towards long-term treasury bond yields, and also an increase in German government bond yields that indicates that at least some safe haven flows are taking place towards Germany. And after the rating reduction for the US, there were slight asset value losses of US assets. And well, currently, no bigger movement out of the dollar, but one could potentially think about dollar losing somewhat in importance and potentially more important role of the euro. But we'll have to see and evaluate that as we go along. Thank you.
Thank you, Kirstin. May I, in this context, maybe also draw our listeners' attention to two forthcoming webinars. There's one on geopolitical rifts, what implications for the international role of the US dollar and the euro, on the 16th June with the ECB, and another one on 3rd September on government bonds, unsafe assets, ? Also together with a colleague from the ECB. So I think both themes sort of link in well with what has just been said. Now, in this context, there is also, and that links a little bit to what Stefan said and mentioned about the theoretical US debt default. Now, what if, for instance, as part of the trade war, China or Japan or both really started selling US treasuries to any considerable extent? What might that trigger apart from simple increase in yields in US treasuries? What's your take on this? Is this one scenario that has been considered by you at the ECB or in the Bundesbank?
Maybe very quickly on that. I mean, it's been talked about, especially as regards China, for as long as the whole topic of global imbalances has been discussed. And I think the consensus view on that has always been that it will be self-defeating, because as the holder of those assets, why would you want to deliberately shoot yourself in the foot and undermine the value of the assets that you're holding? And if you're the number one or number two investor in the market, maybe it's not maybe not the most clever thing to do. So it's always there, of all the range of potential things that could happen. But I mean, I think we've always viewed that as having a scenario that would be very, very deep into the tails.
Okay.
I think what we see is already that China does indeed decrease their holdings of US treasuries. at least according to these official numbers. But yes, I think that it is something that probably might also be in connection with Taiwan, right? So if China becomes more hostile towards Taiwan or begins military action there, I think that the United States could pull this out of the playbook and decide not to pay back treasuries. And this, again, an anticipation of such an event from the Chinese side would mean even more selling before that. So I think that this is a more complicated situation. As I've described, the yields might not be always the thing that establishes an equilibrium there, right? So it might be something that especially high yields, might incentivize. So I think like normally people say, okay, at default, and I did not use the word, Ernest, and I don't think the U.S. administration would ever use the word, right? They would call it very differently. I think from a European perspective, we would really want to avoid this at all costs, right? Any default. A default is always something someone must default after you have used all other means. But the more realistic view on the things is, when do you want to default? When is the situation there where your own interest rate payments that you make are so large that you do not want to make those payments, right? And interest rate payments in the United States fiscal deficit are now very large. They are number 2 category, right? The first category is Social Security. And if you then split Medicare and healthcare, which is typically the split in the US fiscal situation, then interest rates are already number 2. They are higher than Medicare or healthcare on their own. And this is before we have these additional burdens on the fiscal side from the recent tax cuts. So I think there is some potential for severe downsides there. Maybe very shortly, maybe I can try. You said imbalances, John. I'll try to. Do you see it? I did produce a new chart.
Are you doing this real time?
I did it real time now, yeah.
Wow.
I didn't use global imbalances.
So there you are. Yeah, but okay. So we do use that term in other contexts.
Yes,
yeah.
Actually, it was
but we stopped using it. Yeah, I think we probably, usually meant, well, certainly up until the global financial crisis.
Right.
We meant global imbalances. Yeah. So it's a term.
Let me also point out that you already used the word pandemic very early. So you used also in 2006, and you warned from a pandemic in the insurance sector, but it also was short-lived.
Yeah, we were one of the first to draw attention to the impact that climate change was having on the financial sector. So we had a box, I think, back around then on the impact it was having on the insurance sector. I think it was at the time of after Hurricane Katrina or something like that. But this is great stuff, and impressive that you can do that real time, Stefan. Thanks.
So I'm just seeing a new market emerging for ECB FSR watchers. Excellent.
Yeah, there's Caldera et al. Who track uncertainty through all kind of markets, and there might be another paper tracking other words through the ECB's FSR.
Brilliant. Now, I'm looking at the chat whether there are any. Yes, maybe John, you could have a quick look at the chat.
I think the last question is definitely not for me. I think it's for Kirstin.
Yes.
Sorry, Kirstin.
Yeah, no problem. So I saw the question. The question was, since the simulations I presented here were for like the most adverse scenario was a 25 tariff on EU imports and retaliation of 25% by the EU. Now the question was, what if there is a more extreme scenario materializing. So of course we look into kind of all kinds of adverse scenarios. I would say, I mean, like certain scenarios, and for 50% tariff, that it is the case that in some sectors or some products, basically that would prohibit trade in some way. So of course, these types of things are not in the models. And otherwise, I mean, these are more adverse scenarios that at this point, there is a large uncertainty around these things. So that's why I presented a number of scenarios and to give some kind of need to the possible effects, right? And then, of course, there are more extreme scenarios one can think of, and we are considering them internally.
I guess it's the point that they're not they're not linear. You can't just multiply and say, you know, if it's double, it's going to have double impact.
Well,
what you just said there, Kirstin. Yeah.
So, I mean, in principle, from this model, they are kind of linear, so you could extrapolate, but there are other things that would kick in such a situation.
There's just no trade anymore.
So that, you know, it could be that there's just no trade, at least in certain sectors, and you know, so that would make the results look different from what you see in here, just extrapolating. But if you want to extrapolate, then, you know, that's then you have a kind of one aspect that one could think of, but yeah, it's not it's a very extreme scenario.
Thanks. Now, honestly, I would have many other questions also based on the report regarding cybercrime, the gold price, crypto assets, you know, spillovers and sovereign bonds and so on. So this report is really very rich. There are special features, there are boxes. So I can just advertise to everybody to really have a closer look. But time is running out and we need to conclude now. Thanks again for presenting that report. An encouragement to everybody to have a closer look. This concludes our SUERF-BAFFI Bocconi e-lecture on key takeaways from the ECB May 2025 Financial Stability Review. Great thank you to John, Kirstin and Stefan for your presentations and the discussion. And to all of you for your interest and for your questions and comments. I take as a future feature, standard feature, that we will get the word count by Stefan for each new report. Bye-bye and take care.
Bye-bye. Thank you.
Thank you. Bye.
Bye. Thank you.
Thank you.